How do brokers actually work as an industry? And
Okay.
it kind of became a natural kind of evolution of my ambitions and interests. If I have 80% of exposure just in gold and I'm betting all in gold, it's no different to going to a casino. They may try and take advantage of arbitrage pricing. So there's practices which aren't necessarily would be deemed fair for market conditions. So a lot of our risk management tools are actually automated, and in some respects they have an element AI engine involved in terms of the decision making. Don't take excessive risk is rule number one. Desperation can lead to desperate outcomes.
Welcome to Your Bourse podcast, where industry insight meets strategies to grow your bottom line. I'm Elina Pedersen, the co founder and CEO of Your Bourse, the fastest trade execution technology in the retail FX and CFD space. Today, we're joined by Zahid Mahmood, the Chief Risk Officer and UK CEO of Taurex, whose career in risk, compliance, and trading has shaped his leadership in FX, CFDs, and derivatives. At Taurex, he brings a risk first mindset to build a stronger, more resilient brokerage model for the future. Welcome, Zahid.
Well, thank you, Elina. Nice to see you again. I know we've known each other quite a while, but thank you for the
Yeah,
very
it's now
nice
been.
introduction.
Thank you. Yeah, well, remembering it sometimes is difficult, but not with you. So, how did you first get into the financial services, Zahid?
Well, this is going to really show my age. I've actually, so if this needs to be edited, by all means, edit it. But I've been in this industry probably actually over 25 years.
Oh, wow.
Once upon a time, I was going to go into a career in engineering. My background was actually in civil engineering. But having done that degree, I realized it wasn't really where my career ambitions and aspirations lied. So after I actually graduated, I actually worked for the institutional brokerage in a broker in an institutional derivatives department. We actually used to deal with Japanese derivatives
Oh,
when
wow.
late 90s, and again, showing my age here, late 90s, early 2000s, when, post the boom in the Japanese
Hmm.
equity markets, derivatives and equities were still a very big part of, the financial system. So I did that for about 3 years. And then post that, following further academic qualifications. I realized obviously this is the industry I actually want to be in. It's fast moving, it's fast paced, very exciting. I love the fact that nothing is the same every single day. You come in and something's always changed. That for me, even till to this day, is just amazing. I wake up every morning. The first thing I look at is the news, and then I look at how it has impacted the financial markets. Something's been affected, and it's been like an addiction since. And then from the institutional side, once upon a time, again, like most people in kind of trying to make their way in the world and trying to make a bit of extra money, I had like a small trading account, retail trading
Okay.
account. Trying to trade on that, I wasn't great. I'm not gonna even lie. It were on the trading side, it wasn't a great thing for me. But what it did get me thinking was on the other end of it, how do brokers actually work as an industry? And
Okay.
it kind of became a natural kind of evolution of my ambitions and interests. And then I applied for a role as a risk manager and a trading execution officer for a brokerage in London. And then it basically bloomed from there. So basically, gradually, as I went along, got more experience, got involved in spread betting, particularly in the UK. Then that broadened out to CFD trading, and then broadened out to as my experience grew. Then my interest also diversified a little bit. It actually went and expanded into compliance. And I did that for multiple years as well. So again, that was complementing both the brokerage trading side, but then moving on to a different aspect of the same industry. And then subsequently just grew from there and grew from there. And, ultimately I've been fortunate enough to end up where I have at the moment.
So now, can we say it's a liquidity provider? How do you position Torex? What's the right word?
Taurex is a liquidity provider, but it's more than that. It's a lot more than that. It offers liquidity to brokers. It offers the ability to individual clients to trade with us as well. We recently also launched a prop trading business as well. So we have a very diversified portfolio of products. There is no one specific product that you offer. So if you're in the trading space, for example, and if you're particularly in the derivatives and retail, the CFD space, we could pretty much cater for a lot of what people want. So we have a lot of very bespoke configurations for many people. We can offer a diverse range of products. So that's I think one of our key USPs is that we are able to tailor and cater to a quite a diverse range of different clients. So our client base, for example, can extend from individual clients, retail clients, hedge funds, asset managers, institutional clients. We have the whole broad range of them. So it is very diversified, and I think that for us is one of our strongest strengths.
So you're leading the UK team and also you're looking after the risk. So how did you pivot from that compliance, more trading institute role into risk management?
So again, the risk management side originally came about because my career started in brokerage and also in risk management originally, like as a manager of trading books.
Hmm.
Then I made, as I mentioned, the pivot to the compliance side just to broaden my interest and something to do which was complementary to what I'd done. But my interests had always naturally lied in trading,
Okay.
and that's where it ultimately came back to. So having done compliance for about I think 6 years actually. Principally, I had that yearning to go back to what I'd originally started my career out in, and hence I started pivoting back towards more of a trading and a risk management role. So that's when I got back into risk management, basically.
So let's look a little bit on what you do day to day. And I'm just curious. So on the daily basis, when you assess your risk, what would be the most important parameters or factors or signals that you look at? You said, oh, in the morning when I check the news, then I already know, what to do. But on the book side of things or on brokerage side of things, what would be those?
So on the book and trading side, obviously, what I principally look at is what are our biggest positions and exposures ultimately. Now,
Okay.
obviously, one step back from that, the first thing I do in the morning is I look at the financial news to see what has been the biggest movers of the day. And then I correlate that with how has that impacted our biggest positions, because we do run trading risk on our books.
Hmm.
So we have the element of running. We have a portion of risk that we run. We also have a separate STP model, but that isn't affected by the risks that we run on the trading book. So when I'm looking at the book in particular, it's literally looking through what are the news impacts. So, for example, we had FMC recently that
Oh,
had a
yes.
big impact on the dollar. As a result of that, we had gold positions, we had dollar related positions. So, I'm principally looking at what are our biggest exposures, what is the P&L impact of those, and that is very much driven by what is the news associated with those particular positions.
Gold has been incredible. Like, I mean, honestly, if I look at our book, which is not necessarily our book, right? It's the
Yeah.
book of our clients. And I think last month we did something close to 2.5 trillion. And from that 2.5 trillion, gold was 78%. It's absolutely unbelievable.
You're very much echoing what's happening in the industry, funny enough, because again, apart from our book is very similar. We have a high concentration in gold. But again, when I speak to colleagues in other brokers in the industry, and in fact, even when I speak to other colleagues within the firm who also have friends at other brokers in other brokers as well, I should say, same thing. Predominantly 80+% of their volume is all gold. I don't know what it is. It never used to be like this.
Yeah.
Once upon a time, if I look back even literally like 10 years ago, it used to be more diversified. Indices used to be the main thing.
Yes. Yes.
Dow, DAX, that's
US.
what,
Yeah.
yeah, that's what it used to be. But now uh, it it's I think because gold is quite volatile. I
Hmm.
think people tend to look at volatile instruments. But also I think it's a cultural thing as well, because where we focus, for example, is the developing world. So MENA, Asia, gold is a big cultural thing there. Everybody, they buy gold, they invest in gold, they just value gold as an asset.
Hmm.
And I think that's now expanded. The other thing, what I think you'll probably realize more now is trading, for example, has become more global, whereby the developing world and other parts of the world have become a bigger influence
Yes.
compared to what it was, say, even 10, 15 years ago. 10, 15 years ago, Europe, UK, the Western world was the epicenter of CFD and brokerage trading. If you look now, it's flipped the other way. Predominantly, the majority of the trading that you now have is probably offshore. And again, there's other reasons we could go into for that. But apart, one of the reasons I would say is the maturity of people offshore, the
Hmm.
understanding of the product, the interest to try and acquire more wealth. And because of that, that shift is now being reflected in gold trading. These guys love gold.
Of
And
course.
to be fair, I mean, if you look at gold, it is at all-time historic highs. It's never been this high, which I think is driving a lot of interest.
Yeah, I agree. I'm just curious because you did wear a compliance hat for a long time. Do you think S&P event had something to do with it? And in general, the regulators and the change in the regulations that drove the interest away from Europe and the UK?
Without sounding too critical, I think it's definitely had an impact.
Mhm.
100% had an impact. Now, there was multiple regulations that have come in over the last 10 years. This literally started about 10 years ago, roughly speaking, where Western governments, in particular Europe, the UK, wanted to protect their investors. And rightly so. I've got an objection to that because you have to bear in mind it was almost a Wild West if you look back 15,
Oh,
20 years
yes,
ago in
yes.
the CFD industry. There were stories of people losing, their entire wealth, people remortgaging their houses in some instances, just to try and cover their debts in terms of the trading that they were doing. So it was in some respects, I'm giving very extreme examples. I'm not saying the majority were like this, but there were certainly examples where people were losing substantial amounts of money beyond what they can afford. And rightly so, the regulator came in and started, trying to protect these people from themselves. It's no different to, most other gambling addictions. If you
Mhm.
don't manage it in the right way,
Mm.
you do risk a lot. Now, consequently, what's happened is I think it's the pendulum has swung too far the other way, whereby the regulations have become quite onerous and stringent now. So, for example, in the UK, you can't get more than 1 to 30 leverage. And I think the same applies in Europe as well. You've got certain other protection in place whereby you can't trade certain instruments like cryptos, for example,
Mm.
which is instruments that people want. Now, naturally, as a result of that, because you're restricting what people can do developed world, the brokerage industry has to adapt. Otherwise, because it cannot earn the same kind of revenue it was earning as a result of this. Hence, a lot of it is now moving offshore. Now, I'm sure if looking into the future, this is the natural progression of most the world. At some point, they're going to all kind of go towards this kind of
Mm.
maturity and kind of protection for their citizens. But at the moment, that's where the natural gravity is.
Yeah, I completely agree. I think there is a fine line between regulating and protecting and over-regulating and scrutinizing,
Yeah,
where it's no longer feasible for the brokers to run the business, and the traders don't want to be trading with that conditions as well.
absolutely.
So going back to Torex, and as you said, you have the institutional business, you have retail business, you have well, retail. Can we call that retail? You have the prop trading business. So I think the risk books of those different, should we call them departments or branches, is very different, I assume. I'm wondering what would a balanced book look like for you or for like mid-sized broker or like a large entity broker? I guess it's very different for a different branch, isn't it?
Absolutely. I mean, what I think it'd be fair to say right now, if you looked at anybody's book or most brokers' books at the moment, it'd be heavily concentrated in gold. Now, that's far from ideal in terms of what we're looking for. When you're talking about a balanced book, for me, fundamentally, there's two things it has to be. It has to be diversified and it can't be concentrated. So they're the two fundamental things I look at. And funny enough, even when I was looking at our own personal trading book yesterday, naturally, we had very high concentrations in gold. We also had very high concentrations in euro dollar. Those are the two biggest
Hmm.
positions that we had. Um, because of the volatility in the markets recently, we have been, reducing our exposure and the risks in those particular instruments to make them more diversified. So again, just to have balanced exposure across different asset classes. And not be concentrated, and also be diversified in the instruments. So don't have them correlated. So we have exposures, which is more balanced now in Eurodollar, in gold, in the Dow, the US indices, a bit of DAX, a bit of cable sterling dollar.
Hmm.
Now, if those exposures are very similar and they're not correlated, that for me, as a risk manager and someone managing a book, makes me far more comfortable than if I have 80% of exposure just in gold and I'm betting all in gold. It's no different to going to casino, putting all on red and
Yeah.
saying, let's see what happens.
So what do you do then?
We basically hedge it all, a large chunk of it out. So we will, pass on that risk into the market and accept that, whatever happens, that's not our risk. We'll take what we're comfortable with. Anything excessive, we just move out.
I'm just wondering regarding, before I go further on this, regarding correlations. So how do you assess those correlations usually? Do you have anything predefined or?
Well, I mean, there's quite well-known software you can buy that calculates correlation coefficients between different products.
Hmm.
So that is quite standard software that you can buy. You can get a matrix that tells you what the correlation of
Hmm.
different instruments is. And to be honest, a portion of this, it's quite naturally, you can naturally understand it just from
Yeah.
looking at instruments. So, for example, if you have a lot of dollar-denominated instruments, they will
Hmm.
naturally be correlated.
Hmm.
So you don't necessarily need very sophisticated software. A lot of it can be based on just your observations of what's going on and your natural understanding of the product and what is the underlying driver of those products. So that's the principal way I'd say
Okay.
you assess this.
So when do you draw a line between I guess you have risk limits, of course, but is there anything else you look at when you decide, okay, this definitely needs to be hedged out, and this portion we can manage internal or we can manage internally?
Yeah. So there's a number of factors we look at. One of the primary ones is your capital, the capital constraints
Mhm.
for the company. So obviously, naturally, you cannot take more risk than your financial position of the company allows. So that is fundamental to the way you manage the risk of your book. Then beyond that, you're looking at the volatility of the instrument, how volatile it is, therefore how much risk you're willing to take based on the volatility of the instrument. You're then looking at, for example, the clients that are trading it. So are the clients themselves naturally professional people that know what they're doing, have an edge in terms of what they're doing? So that's kind of some of the key factors I tend to look at in terms of deciding how much risk we're willing to take on the book and what kind of level of concentration we're willing to take.
Okay, and if we touch upon more aggressive flow, what and it's interesting because different risk managers, different brokers identify something as aggressive or toxic. Like their definition of it can be different from someone else. So, what's your definition of aggressive flow or toxic
It's
flow?
quite funny to say that because I've had jokes about this in the past. One person's freedom fighter is another person's
Yeah,
terrorist, isn't it?
yeah, exactly, exactly.
It's that
Yes,
kind of
absolutely.
analogy. So in terms of aggressive flow, now obviously we cater to a broad range of clients, so we are able to accommodate quite a diverse
Hmm.
range of flow. So we don't necessarily have that same kind of definition of what we classify as aggressive flow.
Hmm.
There's always a bucket that you can put some of this flow in. But I do know, for example, in other brokers I worked at and other places that colleagues of mine have worked at, what they normally tend to consider aggressive flow. And to be fair, it is quite a reasonable definition. Is those that take advantage of unfair market practices. Now, what I mean by that is, for example, they may try and take advantage of latency in
Hmm.
the pricing system. They may try and take advantage of trading ahead of news, for example, in an illegal way. Actually, that's not even unfair. That's actually illegal, which needs to be reported. They may try and take advantage of arbitrage pricing. So there's practices which aren't necessarily would be deemed fair for market conditions. Now, those are the kind of conditions that where you would want to try and take action and prevent those clients taking advantage because they're not really fair practices. But beyond that, broadly speaking, if you're talking about aggressive pricing, there is always somewhere that you can accommodate this flow. It just depends on the type of flow you have. So we can accommodate people that are trading on algos. We can accommodate people that are, trading over figures, as long as they're not doing something that is unfair.
Hmm. So it's abusing um, the trading conditions or abusing the market. So it's always some form of abuse, and
Yep.
it's not just a profitable trading
We
strategy.
love profitable traders, by the way. So we have multiple clients that are actually very profitable. No objection to doing that, provided you do it under fair market conditions. There's no law against you making money, and it's right you should be making money if you're good at what you're doing, but do it under the same conditions as everybody else. Then there's no issue with anybody.
So speaking about unrealistic trading conditions, and this comes up very often. I think a few years ago, like swap free was everybody was offering it, and to me back then, it was baffling. I was like, how can you possibly do that? How close are your trading conditions to the insti world, or do you still make certain adjustments for your retail traders to be
Def-
competitive, I
you
guess?
definitely have to make adjustments. The two are very similar, sorry, very different business models. You cannot use one state of conditions for another group of clients. So again, because we are quite adaptive in terms of what we do, the trading conditions we give to institutional clients are different to the ones to the retail clients. The retail clients, as you mentioned, always demanding very aggressive conditions. You mentioned swap free; they're looking for almost zero spreads in many instances. Very high leverages where possible. Now, I'm not talking about UK specifically, but again,
Hmm.
other parts of the world as well. We're always kind of benchmarking ourselves against who are the leaders in the market without naming names, and we're always trying to see how we can kind of make sure we're not an outlier as a minimum, and then try and exceed those expectations where we can. On the institutional side, again, when we talk about institutional clients, there's a whole spectrum of institutional clients you can talk about. You have brokers, you have asset managers, you have hedge funds, you have PAM managers, and all those people have a different need in terms of liquidity, in terms of conditions that they want. So brokers, for example, would similarly want deep liquidity, top of the book. They need to be able to execute because they have larger volume that they trade against.
Hmm.
Retail clients don't necessarily need that kind of large top of the book or a deep liquidity because they won't necessarily put in the same kind of trading size. However, they may want much larger leverage. Brokers, on the other hand, have much more funds that they can deposit. They don't necessarily need very high leverage, although obviously it helps them, but they need, deeper liquidity. So we have bespoke liquidity setups for the different types of people, and you certainly cannot use one for the other. We have very long discussions about this. They're certainly catered for different markets, and they are different markets.
From my experience, I'm not a risk manager. For me, when I look, and again, when I look at our book of clients and what they're doing, I can still see that brokers' profitability is pretty much a function of a spread. So it's the spread that the broker is charging at the end of the day. And when I see retail brokers offering zero spread, I start wondering, how do they end up managing their risk if they're offering zero spread?
Very good point. Now, again, I can't speak specifically to us because we charge obviously commission as well. We do
Yeah.
charge
Okay.
spreads. We have some
Commission is
financing.
fine.
Yeah, yeah. So we have financing as well. Now, I know exactly what you're referring to because again, we do look at offshore brokers as well and try and benchmark
Mhm.
against it as well. One of the interesting things about a lot of these brokers offshore is, in many respects, there is almost like a race to the bottom
Mm.
to be the cheapest in everything, and that is very much driven by the client bases of those particular regions. In For those brokers in particular, you are right. When your spreads become so marginal that they're not generating a lot of revenue for you, naturally the only way you're making revenue at that point is basically bebooking or internalizing a lot of their flow and then trying to offset wherever you can. Now we do an element of that, but it's not a primary or sole business model. But again, a lot of these brokers offshore, because it is very much a race to the bottom. It is very much a reliance on trying to internalize as much as you can and then have it offset and then try and make the money that way. It's a far higher, riskier model compared to what has been used
And then
previously.
and then, it's I'm starting to wonder how safe is the client money especially if it's offshore as well.
Well,
So
offshore I can't comment for. I mean,
yeah,
to be fair, but I
exactly.
mean, obviously we're regulated in the UK. We're regulated by one of
That's
the
different.
strongest
Yeah.
regulators that is out there, renowned globally, I would say, across the world. But again, it's a question to be asked. I mean, I can't comment in terms of how the brokers work. There's a lot of very big, successful brokers offshore as well as in more regulated jurisdictions. It is a different model compared to the more regulated model. Now, obviously, if you want a bit of credibility in terms of what you're doing, you should always go with a broker that is regulated, that has history as a minimum. There's a lot of brokers out there. There's a lot of people. There's a lot of things individual retail clients in particular should be very careful of because, yeah, in many cases they're just marketing models to try and scam people out money. I'm not saying majority are, but there's certainly a reasonable portion of those. And I would always advise people just to be very careful about what they decide to who they decide to work with. I'm fine.
Yeah, sure.
Yeah.
Okay. So then looking at Taurex specifically, how much is your risk control judgment based and how much of it is systemized?
The world's changed. I mean,
Y-
a lot. I mean, so the way it works in terms of risk management on our side, obviously, once upon a time, it was generally used to be a framework of risk that you're willing to take. Clients have become very sophisticated in the last 10 years or so. Very sophisticated. Again, when I started out in this particular industry, the retail brokerage industry, people weren't as sophisticated. Now, the amount of algos, programs, other tools that they use for analysis, it's far more sophisticated. So I would say that the portion of judgment involved in risk management is far, far lower. So a lot of our risk management tools are actually automated, and in some respects, they have an element AI engine involved in terms of the decision making. But with that said, there is still a person sitting there at the end of the day looking at holistically what's going on and may in some instances decide we can take more a view on something, and that again requires someone to have that knowledge and the level of insight in terms of doing that. But generally speaking, a lot of our decisions and a lot of our systems are automated now.
Mm.
It isn't used the way it used to be once upon a time, whereby you just had a framework, stuck within your framework. Anything outside that, you kind of just hedged it away, and that's what you stuck with. Now you have to look a lot more deeply in terms of the client's trading, what they're trading, how it's going to impact. You do a whole raft of analysis related to that in terms of, for example, duration of trade, what they're trading, style of trading, and then make an assessment of whether you're willing to take the risk or not.
So do you benchmark then to understand is that flow within your standard curve,
Yes.
I'd say, or
Yes.
yeah?
Yeah, we
Okay.
do. So we have a framework, not necessarily just for the risk that we're taking. We have a framework for type of behavior to identify whether a client is suitable for the type of trading conditions that we're giving them. And there's always conditions that we can give them should they not necessarily fit within a certain bucket. So we can always accommodate people, but there's certainly ways of identifying whether a type of flow is suitable for a certain type of liquidity.
So I guess this protects your P&L in the way. Are there other methods that you use to protect your P&L? Or what's the goal, of because they're different brokers, they have different, of course, risk appetite, but they also have a different approach to that. Like they have a different strategy when they run the brokers. Some prefer like a really sharp curve and they're happy to take more risk where they can, of course, within the limits. Others would rather flatten it and make sure that the income, is stable. And yes, perhaps they're not earning as much during the volatile times, but
Yep.
then at the same time, if it's, one directional, then they're also pretty safe.
Yeah. So, I mean, two things I'd say. Firstly, in terms of protecting the P&L, I say making sure the clients are in the right liquidity pool doesn't necessarily just protect our profits. It actually protects the liquidity providers underlying us as well. So, one of the things, for example, over the last few years, what we found was that when we were giving liquidity, if the clients weren't in the right liquidity bucket, it was actually impacting our trading conditions with our liquidity providers. So, there is a natural interest for us to make sure that we're kind of making sure we're sending the right kind of flow to the LPs that we kind of have to deal with as well, because they're in the same position as us. We give liquidity to others, they give liquidity to us. We need to make sure everybody's happy with the flow we have. But to your second question, which was in terms of the risk profile and how we do it, yeah, I mean, I think it's the former rather than the latter. We were originally in a situation whereby obviously we don't want the kind of volatility that we are kind of experiencing. So we could experience with much larger P&L swings, which
Mhm.
is very prudent to do. But at the same time, if we find this right opportunities to try and capture more alpha and more value, then certainly we do take that proactive approach to try and capture that additional value. Because I mean, I'm sure I'm not the only one that's kind of gone through this. Various colleagues of mine that in other brokers that are also working, they've mentioned that this summer has been a terrible few months for them.
Oh, yes.
A
Yes.
terrible few months,
Yes.
and we're no different to that. I mean, everybody said a tough few months because the market's literally just range bound,
Hmm.
and clients had a great few months whereby they've made a good portion of money. Rightly so, no objection to them making money. But obviously, from a brokerage perspective, if you're going to just rely on a steady income, then that becomes, your returns become more narrower. Then you need the ability to be able to capture additional value to compensate you for when the markets are, starting to move now, which they are, fortunately.
Well, it's September. We're
Yes.
waiting for it. But I think it's always like that. To be honest, if I look back at my experience in the industry, and it's not 25 years, it's only 15. But when I look back at almost every year had been spring is amazing, summer is terrible, and then autumn is amazing again.
Yes.
It's just how it goes.
Once upon a time, there was that saying, selling may go away,
Yeah,
which
exactly.
was literally,
Exactly.
everybody used to go on holiday. I mean, it's funny you say that because it broke that mold a few years ago. So, there was period, I've worked, in times where we had record months in the summer period. But this year in particular, it looks like we've gone back to that selling may go away. We
Hmm.
literally had 3 months whereby it just
Yeah.
sidelined.
Yeah.
And everybody was, on the brokerage side in particular, was saying, how long is this going to last for?
Well, I think there are a few brokers that are struggling,
Struggling.
but perhaps they don't have the tools and risks and controls that you have. But if you would have to give those brokers one piece of advice on risk management today, what would it be?
Um, don't take excessive risk is rule number one. Desperation can lead to desperate outcomes. So just I know things can be tough, but just make sure that you can afford the risks that you're taking. I do know of brokers, for example, that may overextend themselves to try and earn the extra amount of money. I mean, I'm just putting my risk hat on here and
Hmm.
saying that that's the case, but that would be my number one word of advice.
I think sadly, some smaller brokers, they don't even understand what their risk is, or how to calculate it.
Yes.
And when you speak to some of them, you go like, "What's your risk limit?" And they go like,
What is the
"What's
risk limit?
yeah?" You go like, "Oh my." Okay, well, some educating, I guess. Okay, so let's speak a little bit about Taurex. And I'm mostly interested in the institutional side of things, predominantly because I see you growing and doing great on that front. How are you different from other liquidity providers?
We are different in a number of unique ways. One is that we are LP agnostic, so we have multiple liquidity providers that we're connected to. I think at my last count we had about 20 plus
I think you
liquidity.
have more.
Yeah, I think
Like,
we have
I'm
more.
remembering what
Yeah,
you said.
yeah. Of course, as you'd know, we have quite a few liquidity providers. So for the size of our firm, it's a very unique or unique selling point for us in terms of what we can do. What it fundamentally lets us actually do is offer very bespoke and customized liquidity offerings to our client base, especially in particular the institutional client base, which I think is fantastic because when you speak to many established brokers, what you find with them is it's our liquidity or take it or leave it, and
It's
that's
a
it.
box
It's like
solution.
a box solution. For us, we're agnostic. We don't necessarily have a LP that we're tied to. We don't necessarily have a liquidity type of setup that we're tied to. So we have multiple clients that will come to us and say, I want X, Y, and Z. And we will touch wood in many instances, be able to accommodate that. In fact, I'm sure you know this, Elina, as we work together, we have been accommodating that to date.
Yeah.
And for us, I'm very proud of that because it means that we're not tied to any one particular model in terms of what we're looking to do. So for me, I think that's our biggest unique selling point.
So is there an ideal client profile for you? Like who would be if you think of an ideal client, that a brokerage that could really benefit from working with Taurex, working with Taurex. I still sometimes mention your old name. It was Zenfinix back in the day.
Yes.
What kind of brokerage would that be?
We don't necessarily have one particular type of broker. All we ask is, just as long as you're a broker that wants to work under good trading conditions, that wants deep liquidity, that wants us to help them grow, we're open to, open to business, doing, helping you out in whichever way you want. So again, because we're not kind of focused on any one particular kind of client base, we're open to many. I wouldn't necessarily have a ideal kind of client or ideal kind of broker. We already at the moment cater to multiple different types of brokers that have different types of needs. So I can't. I wouldn't want to. It wouldn't be fair for me to say you're my perfect type of client versus you're not really great, but we accommodated you.
Okay, so well then, as you know, it sounds like it's pretty tailor-made. So I'm going to ask you a bit of a trickier risk-related question then, because perhaps you'll give me an answer then. So when you do your KYB on the client, what would be the parameters you'd be assessing? How would you assess the risk associated with that client? And what would be the requirements? Like what conditions would you be able to offer, and how do those conditions correlate with whatever you're assessing?
Yeah, I mean, so this is partly coming on with the compliance hat, and I'm not
Exactly.
in compliance at the moment.
Slash risk.
Yeah, so I don't want to speak for our compliance department in the whole, but what I would say, obviously, naturally, in terms of the compliance side of things, I know when we kind of bring brokers on board, we're doing the standard kind of assessments. So we
Mhm.
look at financial statements, we look at where they're regulated, we look at their trading flow, we look at trading statements to see the kind of flow. We'll then look at the type of trading conditions that they're looking for. What leverage are they looking for? Where is their geographically? Where are their clients based? What instruments will they trade? So there's a diverse range of instruments factors that we look at. We'll then look at, for example, potentially what kind of deposit levels they're looking to deposit with us. What is the average deposit size from the clients that they are onboarding? And then we'll make a risk-based assessment in terms of will this be suitable for offering liquidity, and then deciding whether when we offer that liquidity, is it better if we kind of give a more of an STP model, or is
Mhm.
it more of an internalized model? So there's a number of different factors we tend to look at from both a risk and a compliance perspective. But I think in many respects, I don't think that's any different to many of the larger established brokers out there.
What about NOPs or margin requirements? Whenever you set up
Yeah.
an Insta client, probably you would provide that.
Yes, we do. So what normally tends to happen is that the client obviously will come with specific needs. In many instances, these clients will already have established relationships with other brokers. They will give us NLP levels and leverages that they're looking for. Now, obviously, for institutional clients, even in the UK and the developed world, the restrictions of retail clients don't necessarily apply. So we can give higher leverage, for example. We can give higher NOPs. But what is interesting is that if some of our clients that, for example, are based offshore in Asia, for example, they have slightly more aggressive
Mhm.
requirements in terms of the NOP and leverage levels versus those that are, say, for example, in Europe or in the UK.
So it also depends on the client how you choose to accommodate them,
Yes,
and I guess it would also depend on the entity you would use for that, because I do
absolutely.
know you have different
Yeah.
regulated entities, and
Yeah.
then you could potentially allocate.
Yeah, so we do have. We have an offshore Seychelles regulated entity, associated entity. We also have obviously the UK regulated entity. Obviously, they operate as separate kind of entities, and depending on what the client wants and where we offer the best liquidity conditions, they have the capability of going to the Seychelles entity or to the UK, depending on what they're kind of
Mm.
comfortable with. Some clients, for example, may want the comfort of knowing that they're dealing with a highly regulated institution, hence they'll come to the UK and the FCA entity.
We're moving to our last we're moving to our last section. And I'm gonna ask you for future predictions.
Ooh,
It's like,
that's the hot topic of the day, isn't it?
the historic performance does not guarantee
Yep.
any future results. So, looking at liquidity today and at liquidity provision today, what do you think is going to change or happen? Maybe you have noticed some new asset classes entering the market or becoming popular. What do you think is going to change in a year, 6 months? I can't really look further than that, I guess.
I mean, again, this is my crystal ball,
Yes, yes.
so please don't hold me to this. I know this is recorded. Warning, in underlying this as well.
Not a financial
No,
advice.
there's not financial advice, but I mean, I can, basically because you can kind of gauge where the industry is heading from the demands and requests being made by the clients that you're kind of, the requests that are coming to you. So again, not UK specific, for example, but the Seychelles entity, cryptos, generally speaking, is becoming the new kind of hot area in terms of um, where clients want to try and trade. I know they're a lot more restricted in the UK and in Europe, but offshore, for example, there's a big demand for cryptos, and rightly so, because again, if you look at Bitcoin and you
Spot CFDs.
perpetuals, for example,
Perpetuals, okay.
CFDs and perpetuals is where
Mhm.
a lot of the interest lies. So that's one area, for example, where I think. There's going to be growing demand because as cryptos become more mainstream, because they are gradually becoming more mainstream, there'll be more of a requirement for that, for the liquidity in those. But at the same time, what you're going to then find is that there's going to be a lot more regulation in the crypto industry. I mean, I think if I'm not mistaken, I'm already reading stories or somewhere that at some point in the coming years or so, or months to years, there'll be further regulations of the crypto industry itself in particular. The
In
other
the UK?
UK,
Yeah.
Europe, and maybe even possibly more globally than that, but certainly in Europe and the UK as a starting point. At the same time, the prop industry, the retail prop industry. Now, this isn't the prop industry of once upon a time where you had professional traders sitting in trading arcades trading away. It's a different trading model to what
Mhm.
used to used to happen 20, 25 years ago. Again, it is not regulated at the moment, the prop industry, but again, I see the prop industry becoming regulated at some point and becoming being brought into the main fold of the rest of the brokerage industry. So again, it's like a natural evolution of the more higher risk, I would say, parts of the industry where I think they're going to become more mainstream. But at the same time, that's where the demand is at the moment for many of these for these products.
So now that you've actually talking, I mean, prop, the funded contest thing, prop, it's always, I mean, it's so different. A lot of brokers launch it and they think it's really similar
Yeah.
to what traditional trading industry is, but it's so different. How do you manage risk on that?
So I'm not. I'm again just to caveat this. I'm not involved on that side of the business. That's a completely different unit. It's not necessarily part of the brokerage industry as
Mhm.
such. So there's a different entity with a different setup and management, so on. But I am aware of how that prop industry works, and it is a completely different model. So compared to the brokerage industry, for example, obviously the revenue earned is via commissions, financing, and so on. The prop proposition is again, when I first heard of it, it flipped my mind a little bit in terms of the way it works. It's very much a purchase driven model.
Mhm.
You buy challenges, so to speak, and it's like a one off payment. So from a broker perspective, your revenue stream is very much just the purchases, and then at that point, there's no upside for you because the way the model works is, if these people buying these challenges pass those challenges, then there's a profit split in terms of the trading that they do. So, from a risk versus reward ratio, perspective, from a broker, it is more skewed in the client's favor. But in some respects, that's not a bad thing because what it does try and do is instill in clients that take the prop model to have more discipline, more trading discipline, that is, and manage their risk a lot better versus the way they do on the brokerage side, because the prop industry has quite strict conditions that it applies to these traders in order to pass those challenges. And once they pass those challenges, then they get a rev share with the broker. So it is a different proposition. but it also changes the model between the broker and the client versus the traditional model.
I think there was something like 80-20 rule on the pass rate and payout ratio that
Yeah,
the prop firm should not exceed
yeah,
to be able to prudently run its business. And I
yeah.
think the ones that do end up offering different trading conditions are the ones that end up burning bright and quick within 6 months.
Again, for me, I see the prop industry almost like the wild west of where the CFD and brokerage industry was, say, 15, 20 years ago.
Hmm.
It's the now the new booming area, new booming part of the business. So I do agree with you. I think again because I'm just being cautious of what I say here because it's not the industry I'm particularly or the area I'm particularly involved in. The way they manage risk and the ratios of win versus loss, I think you're not far off in what you're saying. And the way they kind of do it is slightly different to the way the retail and the other brokerage industry works.
But are there any maybe hot trends that you see in other parts of the industry, not just the trading related, but what is it that you think is going to enter the industry that might be different, perhaps AIs? I don't know the number of time but I hear AI every day is just
Yeah.
absolutely.
I think AI is certainly a growing area in the industry. I mean, again, I kind of touched on it a little while ago, which is even some of the analytics that we use have an AI-driven engine that actually determines and starts, assessing the client behavior and the trading behavior, and then it learns from that. So you give it feedback, you give it your view on what it thinks. It learns from that and then kind of assesses that. I do think this is the future. I think again, no one's going to be able to avoid AI, both from a risk management perspective and even from the trading tools that clients are using as well. So I think that is definitely one of the major trends that to keep an eye on going forward.
We definitely see at your bus, and it's quite spectacular. So I don't think there is a department that is not using an AI,
Absolutely.
including like programmers. Just, um, I think they use it more for unit tests and things like that. But still, it saves so much time. And I'm wondering because we never hired juniors, but I'm just now wondering how will juniors get the experience? Because before that, it would be a junior job to do that.
Yeah.
Now it's an AI job to do all of those very routine small tasks.
It's funny. I mean, just on a side point, and anecdotally speaking, I've got a 12-year-old daughter. She uses ChatGPT to plan her week. And it shows you how the world has changed, how it kind of infiltrates. AI's infiltrated every aspect of everybody's life. When I heard that a 12-year-old is using ChatGPT to answer some of her questions and then to plan her week, it shows you how much things have changed. And to your first point, I do think yeah, I think there's an element of the juniors coming into the industry and generally speaking, I mean I see AI as an enabler of people's abilities. I don't see it as a detractor
Hmm.
because what it does let you do is if you're a junior coming to the industry, it allows you to be more focused in terms of what you're looking to do. I think AI is good for complementing what you're doing, but ultimately at the moment you still need a human brain to distinguish, is this a reasonable answer? It can help you, but you still need to give it feedback. So I think in many respects, it will sharpen people's skills to really be more critical about their thinking and then make a decision on, is this a good answer? Because without that, AI is as good as the feedback you're giving it.
There was an interesting research, I think, done by Harvard. And ultimately, what they did, they gave a task to students and they said, okay, to write this paper, one part could use an AI and another one couldn't. And they also correlated it with those that actually do use AIs in daily work and all the professors who didn't. So ultimately, what they came up with is that students delivered a better paper when they were working with AI. But as soon as you took the AI away, they weren't any more capable of actually putting their thoughts on the paper. So the whole writing style of the research declined significantly because we're not used to actually
Yeah.
forming it anymore. We're just used to saying, oh, edit this, change that, and sharpen this.
Yes.
So I think it's going to be just a different skill set,
I
perhaps,
do
that
agree,
people.
but I mean, I don't think that would detract from people having to use their brains ultimately.
Yeah, yeah.
You will still need that skill set. I see it as an analogy to when the Industrial Revolution came in or cars came in. Horses and carriages were, worried, they're going to be out of business. But what happened? You had other industries booming off the back of that. You still needed people. I don't think people will ever be replaced. They'll need a different skill set.
Hopefully, we'll just get a shorter work day.
We can always wish.
Yeah, you can always, but it's been shortening, so we're going towards that. Thank you very much, Zahid. It's been a pleasure, and you've shared some amazing insights. I'm sure our audience is going to benefit from. Like, share, subscribe is what I need to say. Otherwise, I'm going to be told off by my marketing manager. Thank you for joining us.
Thank you for the time.